Hey guys, it is Markets with May, and it is Friday, March the 25th. And it's another crazy day in the markets as per usual. I really think this is going to become one of the greatest shows on earth for people. And that's why people keep coming to the stock markets. We are going to go through a few cleanup items very shortly. I am super excited to have an old friend and an amazing resource within real estate, the actual physical asset. So we're going to do something a little different because I think it's really important for folks, especially during this quiet period where companies aren't reporting, to get educated on what to do with all of their money, not just the portion that's being actively traded. But we've got some cleanup items because this market is nuts. Okay. Now, I want to say, as per usual, past performance is not indicative of future returns. And so, you want to kind of keep that in mind. But we are going to try to give you some great information and ways to think about things today. All right. We had a crazy lineup of economic data, and we've got an even crazier one coming in next week. I actually had to split the screen because usually I can put this all on one little thing. But because I think there's so much influx as relates to inflation, you've got on Tuesday, the jobs data right now, people are watching like a hawk. You got trades. It's more trade data coming in, and that's going to be very relevant because geopolitically things are so unstable. You've got gross domestic income coming in, and really right now everything about raising rates and everything is banking on the fact that this inflation is going to be offset by people making more money. And you've got that both on Wednesday, some data coming out, Thursday, that data is coming out. And then on Friday, you have a bit more from the manufacturers. So far, they have been spending, and that's really important because when they stop spending, then we go into a period not of just inflation, but stagflation. And that has been something that we have been watching like a hawk at Markets with May. So I wanted to mention that. Now, one little cleanup item, pending home sales index, that actually came in better than expected, even though everybody's reporting it like it came in worse. Folks are expecting things to be down 5.7%. It came in down 4.1%. A little bit. So pending home sales is something that is absolutely to be considered. And we're going to really be watching for that as things continue. Now, the other thing I just wanted to mention here is that we have this headline started the markets out a little bit strong. And as we can kind of see from the crude oil index, it's now up 100 basis points, 1%. But it originally started out the day down. And I woke up and I was like, what is going on? Why do people think oil is not priced correctly? And it really was this. The EU strikes a gas deal with the US as it seeks to cut its reliance on Russia. Here's the thing. Why the US can't quickly wean off from Russian gas came out as an article in the New York Times almost immediately after. And we have mentioned more than once that it just doesn't work that way. Now, one of the things that's a really lucky thing for the next 3 months, April, May, and then to a lesser extent, June, so really finished up this month, is we're in what I would call the shelf period of energy, meaning that in these next 3 months, if we're lucky, Europe will be able to stockpile enough energy before we in the United States start to really need it. Okay. So it's not that we just have to increase capacity and the oil companies have to do what they're doing, but it's also this. Okay. We had a huge movement from north to south. And while the percentages look a certain way, the raw numbers will tell you something different. I mean, Florida's population is large and they had 500,000 people move south during this period of time, Texas, et cetera, et cetera. These are all places where the utility companies have been working very, very hard to continue to increase capacity and provide air condition. That's really what this is all about. So the idea that the US is going to make up for the shortfall of Europe and also be okay is really banking on one thing, and that is Mother Nature playing ball. Because let me tell you, these are the temperatures just in Phoenix, and you'll get the same thing approximately in Texas. And in Florida, it's ever so like maybe 2 degrees lower on the highs, but you got humidity. So you really can't just be thinking, oh, it's going to be fine. No. This whole thing that we're going to be able to produce enough energy for the 2 continents, if you will, is a really special something. And it's only, I think people are only brave enough to say it because we are in this shelf period. Now, we actually started talking about coal as early as January, but last week when CEIX Console Energy was at $33, I was already talking about the fact that you should try to buy calls on it. I think then I just got sick of it and said, I really need to come out a little bit more aggressively. This is from yesterday, I think, maybe 2 days ago. And we talked about the fact that the reason I like Console Energy is where their stuff is located. They're mainly mining here. And in fairness, I'm not a fan of the use of coal. But at this point, I don't know how Europe manages to have enough energy to not create bigger issues for themselves without coaling up, for lack of a better way to describe it. And if the US is going to export out a bunch of LNG as it's still trying to increase production, that implies that we're going to have enough coal to just make sure that we don't have major issues. I mean, these are temperatures where people can really, really experience medical issues. And in the northern states, if Mother Nature just decides to not care about all of us, you can actually sue for damages if their building is not heated correctly. So just realize Console, because it's on the East Coast and they literally had spent the last few years doing the CapEx so they could ship it right to Maryland and right on over to Europe. Just realize that that's a real thing. That's why we preferred Console to Peabody. But in fairness, if the world is going to be short coal, the world is going to be short coal. We still like these pipeline companies. And then the last little follow up, because I felt bad about about NVIDIA. You know, David was like, May, you kind of blew me off. And I was like, you know, it's a fair point. I didn't mean to blow you off. I apologize. But the NVIDIA, I want to be really clear. I am a bull NVIDIA. It's just always hard to know what this market in a very volatile setting with all of these other factors, what valuation it should receive. NVIDIA grew 66%. The bottom line growth, top line was in the high 50s, and it trades at this point around 1 times its growth rate, in my opinion. Now there's a bunch of extra items, so other analysts may disagree with me, but it's not necessarily, since it's traded in a range of as high as 2 times its top line growth, and then however you want to think about the bottom line growth. If it were to retrace back to this 333, I wouldn't feel like it was necessarily an expensive stock per se, given where it's historically traded. Now, right today, it's kind of doing this 275 thing. And what I would mention is that one thing that you can do with NVIDIA is you can actually go long. You can just go out farther back, right? And there are options that will give you long-term capital gains. So this is June 16th, 23. This would be a retracement of 22%, right? So in order to break even on this, you would need this stock to land at 326.50. A full retracement would be 333. And you can actually get this done at 575, 625, which would pay out $13 or about a 220% return year over year. Okay. Here's the thing. You will not be able to do any kind of meaningful size. As you can see, this is the volume. So you're going to have to work that trade. And I will do a separate video on how to think about this, because you don't have to do exactly this trade. You can just try to see where you can get the liquidity off, or you can make the spread wider. So I will do a separate video on that because I don't want to take away from my wonderful guest. The last thing that I will say that I will be talking about more next week is volatility option spreads. And in this marketplace, I've noticed that the VIX is trading in a range of 20 to 30. You're actually getting to 30 every other day sometimes. And it's good for you to have protection. And there's a few different ways you do it. In different times, you would do it different ways. I actually think that the call spread where you actually are a bit in the money is a little bit better. But today's not the day we're going to talk about that. We have talked about it on past episodes. With that, I want to introduce my guest, who is, now, the one thing that's really amazing above everything else about Matt is Matt has been doing this since 2007, single family home investing. And right now, because I think the markets are starting to get really aggressive against this asset class, me as a contrarian, that's when I start to be very, very interested in learning why, how, when, because quite frankly, that doesn't jibe with how I've actually made my wealth over the course of years. Now, the other thing that is always really fun about Matt is a global nomad. That's actually how we met. He's been at South and Southwest talking about how to build a business of that nature. And I'm going to let him talk about himself. But I think the first thing he should tell us is, Matt, where are you talking to us from at this point?
Today, I am coming to you from Medellin, Colombia.
It's amazing. That's amazing. And yet investing in real estate, guys. So this does not necessarily have to be the way that everybody talks about where you can't move around. Now, Matt, go ahead and tell us about yourself because you know I won't do it justice. You're really
I don't know how much you want me to tell. I'll sort of try to summarize it. I mean, my initial background in terms of academic and work experience has absolutely nothing at all to do with what I'm doing now. I have a master's degree in international peace and conflict resolution. All of my professional work experience was actually in the nonprofit advocacy space. And as I was in the nonprofit advocacy space, I realized, I said, you know what? I'm never going to make a lot of money at my job in this space. So I should figure out how to invest on the side. And so that was way back in the day. I mean, almost, I don't even want to say how many years ago now, but I started buying rental properties, right? And first I bought a house to live in and I rented out 3 of the bedrooms to friends of mine. So all of a sudden I had passive income coming in from my tenants. And then what happened that year was that the house appreciated in value more than my entire annual salary at my job. And I said, well, that was interesting. I could have just sat on my couch and played video games and made more money than I did at my job. I had passive income and I literally made more in the appreciation. So that put a light bulb there. And I said, let me see if I can repeat that. So then I started learning about how to buy out of state rental properties in markets that were more advantageous than where I was living. And then what happened was my friends started approaching me and they were like, dude, how are you buying rental properties? Like, how are you doing it out of state? How are you doing, So I said, well, let me show you. I'll show you what I'm doing. And so I started helping friends of mine buy the same rental properties that I was buying in different places and stuff like that. And I noticed as I was doing this, I was just doing it because they were friends of mine, but I noticed that the real estate brokers that were helping us to buy these properties were getting a commission on the HUD, but we weren't paying it. So I was like, that's cool. They're helping us out. They're providing this value. They're helping us find these properties and they're getting paid for it. Fair enough. But we're not paying it because in the United States, the seller pays 100% of the real estate brokerage fee. So what happened, fast forward, I ended up leaving my job and deciding that I wanted to go the entrepreneurial route and I wanted to start a business and that I understood this real estate brokerage model. I'm like, wait a minute. If I just start a real estate brokerage, I get officially licensed and everything else, I can literally just keep helping my friends buy rental properties. All of a sudden now I can get paid for it, but I don't have to charge my friends any money. I was like, this is the perfect business model. And then I can grow that. I can have more clients and more customers. And I literally never have to charge my customers any money. I was like, this is the perfect business model for me. And so we founded Maverick Investor Group in 2007. And the business model is that we help people buy cash flowing single family rental properties, sometimes 2 to 4 unit properties, but all residential investment properties, no commercial. That's our niche, right? And we help them to buy those in the most investor advantaged US markets, no matter where they live. They can buy out of state because these properties are what we call turnkey. That means they're either brand new construction or they are fully renovated already, and they have a tenant in place on a long-term lease paying rent, and they have a local professional property management company who is collecting the rent from the tenant, handling any maintenance calls, dealing with all of that so that you don't have to be the landlord or the rehabber, but you get to actually own the deeded freehold real estate. You get all of the benefits of owning that hard asset, and you can do it from anywhere. So that is the business model, and we've been doing it for over 15 years now.
Now, I know that since you've been doing it for 15 years, you're a little different than the person that just decided to do it yesterday. Can you talk a little bit about, I feel like there are 2 things in particular that you've always told me that I've always thought was very interesting. First of all, not just 2, don't worry, Matt. It's probably more than 2. All right. So first, talk to us about the ebbs and flow of the real estate market, because I do think that's kind of important. And also talk to us about locations and the such, because the thing that's always struck me is you're hanging out in Medellin right now, and you've been all over the world, like 70 countries, I think, or maybe more than that. Probably more than that at this point is my guess. Anyways, talk to us about both of those dynamics as folks think about it, because I think most people are only thinking that they can buy in their local market.
Right. So first of all, 100% of our rental properties are inside the United States, so governed under U.S. real estate law and all that kind of stuff. I just happen to be gallivanting around the world for lifestyle design purposes and living that nomad life while running the business in a location independent fashion. Right. So I just want to be clear that we're talking about all U.S. rental properties. With respect to the U.S. real estate market over the last 15 years, it's been very, very interesting because one of the things that's important to understand is there is not one U.S. real estate market. There are many different U.S. real estate markets. And so one of the things that we did actually with our business model from day one is we said, okay, here's sort of the downside of a traditional real estate brokerage. Well, one is that they, that they are not selling investment properties. Typically, they're just helping people buy houses to live in, which is totally different because 100% of what we do is deal with real estate investors. We've never helped somebody buy a house to live in. We've never listed a house on the MLS. We don't do that at all. It's entirely off-market buying opportunities for regular individual real estate investors. So that's all we do. That's our niche. And what's been interesting over the last 15 years is that the most advantageous markets to buy in have changed over time, right? Because local real estate markets go in their own property cycles. Now, if you're a traditional agent, typically you're in one city, you're in one location, and all you have to sell is the properties that are available to you in your local market. And so what you do is you start with the product, and then you have to retrofit your marketing materials to try to sell whatever it is you have access to, right? And so even if your market becomes really disadvantageous for investors, you have to find a way to tell people it's still good time to buy and convince them to buy and retrofit your marketing materials because all you have is that product and that's your livelihood, right? We wanted to flip that entirely around and say, we want to put the real estate investor first. And we want to have the latitude to help our clients buy in the most advantageous markets, regardless of where they live. And so our company is real estate market agnostic, right? Like we don't care which market you buy in. We're not financially incentivized to encourage you to buy in this market or that market. We want to be able to give you the options to buy in the most advantageous markets at the time you're ready to buy. And so back in, say, 2010, let's just do like a 12-year throwback, right? Our most popular market that year was Phoenix, Arizona. Why? Because the real estate crash had just happened in 2008, 2009. There was all these nearly new construction homes in Phoenix that had been built like 5 years prior. The market had cratered and you could pick these things up for lower than builder replacement cost. Wow. But the rental market hadn't tanked. So you could still rent them for a decent amount and you could lock in that really advantageous price to rent ratio and get a good cap rate. What happened then is that the market soared up in value over the next couple of years. The rental market, though, didn't keep pace with the home price. The home price just went way up. So now what happens is a process called yield compression, right? Where all of a sudden you're buying the same home for way more money, but you're not getting more rent. So it just squeezes your cap rate, right? And your return on that is just going to be a lot less in terms of the cash flow. And so then we have started helping and the next year after that, probably 2012 or so, Atlanta, Georgia became our most popular market of that year, right? And then the same thing happened.
Pause you for a second, because you threw out a lot of jargon and we try to make sure that we allow people to keep up with the jargon. So first of all, let's talk about builder replacement rate, because I think that's a really important point that a lot of people don't understand. And then let's talk about cap rate in particular, like the components of that, because you did go through it, but I want to make sure that it's clear for those that are just coming into this, how to think about it framework wise to begin with. So go ahead.
Yeah. So that was a very unique moment in time. And what I mean is that you could buy a home for less than it would cost a builder to construct that home, right?
Yeah. Like there's an inherent cost to actually buying materials and all that good stuff. Yeah.
Right. Yeah, exactly. So the builder is going to build it for a particular cost. They buy the land, they buy the lumber, they, put in the labor, they build the house, and then they're going to put a profit margin on it and then sell it to you, right? And so what happened was, because that crash was so extreme, you could actually at the time buy it for lower than it would cost anyone to build it. So, it was basically, this crazy opportunity, right? And that happened for a few years. And then there was, the market went back up and everything, but the market went back up in different ways, right? So let me also define capitalization rate, which is a metric and let me actually give you a couple metrics to think about when you're talking about rental properties, right? The first one, and the very, very high level one, is what we call a price to rent ratio, okay? Or a rent to value ratio, however you want to express that. And basically what that means is, Mei Ling, if you were to buy a property in Manhattan, let's just say, I don't know, for the sake of this example, if someone was to buy $1 million property. I don't even know if you can buy $1 million property in Manhattan. Let's say
you can. We haven't covered.
All right. So let's say you can buy $1 million property in Manhattan. How much ballpark do you think someone could rent that property for, would you say?
Well, actually, rents have been so fluctuating, probably $3,600 or something.
Okay, so let's say in Manhattan,
maybe 4,000, something like that.
Okay, so let's say in Manhattan you can buy a property, just for the sake of this example. We're not quoting anything, right? Just giving you a hypothetical with easy numbers. Don't
come find me. I don't have $1 million property to rent.
Let's say $1 million property rents for $4,000. Okay, so your price to rent ratio there, pay $1 million put $1 million into real estate and get $4,000 in gross rent, right? Now, if you were to do that in a different market, okay? So one of our most popular markets over this past year has been St. Louis, Missouri, okay? And if you were to spend that same $1 million in St. Louis, Missouri, you could actually buy 10 fully renovated single family rental properties for 100 grand each in a nice suburban area, majority owner occupants, that kind of thing. And you could get approximately $1,000 per rental property in gross rent. So now you're getting into this concept that we call geographical arbitrage, okay? Where if you deploy $1 million in New York City real estate and you get $4,000 in rent, well, if you went over to St. Louis, Missouri and deployed $1 million into real estate there, you could get $10,000 in rent per month, right? So this is what
for $100,000 in St. Louis, Missouri. St. Louis is cool though; they have a good scene.
Absolutely. And so this sort of brings us up to what we're talking about, these different markets, right? So we went through and we had different years. If you said, oh, what was your most popular market in like 2013? I would say, oh, back then it was Houston, or 2014, it was Dallas. And all of these markets are at different phases in their sort of expansion cycles, right? Right now, these Midwestern markets, incredible, because they're going up at double-digit appreciation rates.
Wow.
But the price to rent ratios are significantly superior, okay? And so that's what we help our clients do. You want to live in San Francisco, you want to live in LA, you want to live in New York City, you want to live in these really expensive markets because it's amazing to live there, fantastic. Like, I love New York, I love LA, I love these places, but we want to empower our clients to be able to buy real estate where it makes the most sense, in the same way that you don't care if when you're buying stock in a company, you don't care if the corporate headquarters are in your hometown or not. You want to buy stock in the best company. So Same thing with real estate. We want to empower our clients to buy in the most advantageous markets, regardless of where they happen to live, okay? Now, this gets us back to the cap rate discussion, because when you look at that price to rent ratio, that's only a very high level metric, okay? Now you have to look at what are your expenses on that property, okay? Because different states in the US have different, for example, property tax rates. Okay, if you're buying property in New Jersey versus if you're buying property if you're buying property in Alabama, your property tax rate is going to be dramatically different. If you're buying property in Texas, which has insanely high property taxes, versus if you're buying in Missouri, very different property taxes. So here is where this capitalization rate metric comes in, okay? So very high level rent to value ratio or price to rent ratio, that's a high level metric. Now, okay, what are the expenses? What are the property taxes? What is the insurance amount, right? You might live in some zone where you have a high insurance rate, right? Like a hurricane zone or a flood zone or something like that. So look at that. Then you're going to pay a professional property management company to manage this thing, because you don't want to be the landlord of the rehabber, and you can't be if you're out of state anyways, really, right? And then you're going to put in an estimate for vacancy, which will be an inevitable expense of owning real estate over the long term. Eventually, your tenant will move out and you'll have to get a new tenant, and there will be some vacancy. And maintenance, right? So maintenance and vacancy are the two what we call variable expenses. You don't know exactly how much they're going to be, but they are a certainty in real estate if you hold it over time. So just put an estimate there. And once you subtract your property taxes, your insurance, your property management fee, these are all operating expenses, right? You then, and your repairs and your maintenance, you subtract all of that. Now you get to your net operating income. Okay, that's what's left over after you subtract all of those things. And you take your annual net operating income, right? What that property will generate in 1 year after all of your expenses are taken out. And that number divided by your purchase price is how you get your capitalization rate. And so it's a much more accurate type of metric than just the price to rent ratio, because now you factored in your expenses if you're in a high property tax area or you're not. Like, what is your cash flow actually going to look like? So that's what cap rate is.
Cool. Now I'm going to open it up to some questions because I feel like you said a lot in there, which is really awesome. And also, if you're watching this and you're like, oh man, I need that on a piece of paper, don't you worry. We will have Matt's details in the comments below, as well as it'll be in the Discord as well for subscribers of Markets with May. But let me open it up. Are there any questions? If not, I'm going to ask a bunch of questions.
Go ahead, May.
Oh, okay. So, you started to talk about which markets are most advantageous now and which markets are most interesting. I want to hear more about that. And also, I'd like to hear more about property managers and how that's all established and how you think about that. Because you've been doing this for 15 years. So it's not like this is just fly by night, I'm guessing, at that point, whether this can be done or not.
Yeah, 100%, right? So there's different advantages to different markets, okay? And let me give you two different types of, two different sections of this asset class that are popular with maybe two different types of customers of ours, okay? So one of them is the buying in aggressive growth markets. And when you buy in aggressive growth markets, your upside potential in terms of appreciation is a lot higher. But usually the trade-off for that is that your cash flow or your cap rate will be lower. Okay. So to give you an example, as of today, okay, there are aggressive growth markets that we are in, including Southwest Florida, including markets like Charlotte, North Carolina. So here you're talking about markets that are over the last year did well over 20%, home price appreciation. I mean, extremely aggressive appreciation, right? And we have brand new construction rental properties that are available there. They are being built in established owner-occupied communities, which is actually very important because you don't want a new construction rental property in a community that's 100% rental properties, because then you're basically in an apartment complex and you don't have the resale path down the road to sell that to an owner occupant the same way you would if your rental property was in a majority owner occupied area, right? So all of those things are important. And so we have some clients that want to buy in those types of markets. They want to buy brand new construction homes with the granite countertops and the stainless steel appliances in the owner occupied communities. And all that kind of stuff. And there you're talking about more of like a $400,000 starting price, which for people in Manhattan is still like, whoa, that's a steal, man. Right. But when you think about St. Louis, Missouri, or
money, Matt, it's still money. I still got to come up with it.
When you're talking about the Midwestern markets, though, right? Kansas City or Indianapolis or St. Louis or those kind of markets. Now you're talking about a place where you can get a fully renovated home. Granted, these are older homes that have been renovated. So it's not going to be that new construction home, but you can still get them in nice suburban areas, fully renovated with tenant in place for closer to 100,000 or 150,000, right? So now you can, and those are going to have cap rates that are going to be closer to 7%, whereas the Florida properties might be closer to 4%, right? And so you're sort of doing this trade-off between aggressive growth and as well as the new construction. I have some clients that really just like the new construction. They like the 210 builder warranty where you have a 2-year a full warranty, a 10-year structural warranty, like all the appliances are brand new and you have manufacturer warranties. And some clients just really like the feel of that. They're in areas and they look like houses that they might live in themselves. And they just kind of like that, as well as the higher appreciation potential. And I have other clients that are very yield focused. Now, these Midwestern markets, as I said, are still going up double digits, right? I mean, it's not like they're flatlining or something, right? They're still going up double digits, but you get that higher cap rate. And you can buy 3 or 4 properties for the price that you could buy one. So now you have more doors, you've diversified your vacancy risk, right? You know, that kind of stuff. And so a lot of our clients will do that type of strategy where they're buying multiple properties. You know, we would like to help all of our clients to build a portfolio of rental properties over time. And that helps to diversify out the vacancy risk and things like that when you do that. So to your property management question, The way that works is, so all of these are in, major metropolitan areas. Okay. So in any of these places, there are numerous professional property management companies you can choose from. And of course, you are welcome to use any management company that you want, and you're welcome to interview multiple ones and choose the one that's best for you. We always like to provide a preferred property management company when people are, that's part of sort of the turnkey opportunity, which is like, this is the property management company that manages most of the properties in this market for our clients, right? And for the provider that is offering these properties, and they have this track record, and you can interview them and look at their property management agreement. But basically, they give you, you'll log into your portal, you can look at 24/7, and they show the rent came in, and then if there was any expenses that went out. It's all online, and then they just direct deposit the money into your account, and you just watch it flow. And then if the tenant has any issues or they have a maintenance call, the toilets, they just deal with the property manager. They don't know your name, they don't deal with you, but you get all the benefits of owning the deeded freehold real estate. This is very different from owning a real estate backed security or buying a REIT or something like that. And maybe actually, at this point, I should talk about what some of the unique benefits are of actually owning the hard asset. Should I do that?
True. You should. But you guys, don't stop doing market stuff either. Okay. You need to diversify across asset classes is what we're saying here, guys.
So one of the things I think is important to understand about residential investment property as an asset class is that it's very unique in many ways. So a lot of asset classes, the move is that you buy something and then you just hope it goes up in value. And you just kind of hope and pray, I hope it goes up, I hope it goes up, or you short it and you hope it goes down, right? But you're betting on the asset doing something. You're betting on the asset doing something. And if it does, oh, good. If it doesn't, oh, I'm screwed, right? And for that matter, though, if it does what you want it to do, okay, and you make that profit, and you get out of the position and you're like, ooh, I made some profit. Well, then you have to pay your capital gains tax, right, on that profit. And then whatever's left over, you need to hope that beats the rate of inflation in order to make a profit in real dollars, right? So you have all of these different levels of sort of assessing this, like the post-tax and the inflation adjusted and all of this. Okay, so that brings us to rental properties. When you buy a resident, now sometimes you do get a second profit center. So if you buy like a dividend, stock, or you buy crypto and you stake it and you get some yield on your crypto, you have two profit centers there, right? So you generate, it's not just the appreciation. So, but when you buy rental property, you actually have 5 profit centers that are working for you all at the same time. Okay. So number one, we already talked about the market appreciation potential, right? And none of this stuff is guaranteed. Of course, we don't know what the market's going to do next year. But that is a potential profit center, market appreciation. Number two, you have the passive income, which we just talked about, right? Your rent comes in, covers all your expenses, and the rest of it comes into your pocket. So that's number two. Number three, you have, if you get a mortgage on this property, okay? Now, this is very important, okay? Real estate is the most debt-favored asset class in the United States. The bank is willing to lend you the supermajority of the money to buy this rental property. And right now, they're willing to lend you money at a rate that is lower than inflation, which is crazy, okay? Yeah. So
it's crazy, actually.
It's crazy, right? And so you can borrow, if you're an American and you qualify for a conventional mortgage, you can usually borrow 80% of the value of the rental property and put only 20% down, okay? But you get 100% of the appreciation, which is crazy. So let's say that the market, you bought a $100,000 property and you put down 20 grand and the real estate market goes up 10%. You're like, oh, the market went up 10%. Wait a minute though, you only put down 20 grand and the property went from 100 to 110,000. So you made $10,000 on a $20,000 investment. That was actually a 50% return that you made on a 10% increase in the market. Now you put some closing costs in there as well. So let's say maybe you put $26,000 down. So maybe you made a 40% gain. Okay. But that is the advantage of financial leverage, and real estate as a hard asset is the most debt favored asset class. So you can borrow and now you can leverage your return on the market appreciation. Then you've got your cash flow, which is also flowing to you each month, right? So even if the market doesn't go up, maybe it just stays flat and it does nothing. Well, guess what? You're still collecting that passive income every month. And guess what else is happening? Even if the market stays flat, doesn't go up at all, your tenant's rent is covering your mortgage payment, right? So if you lock in a 30-year principal and interest mortgage, every month your tenant's rent is paying down your principal for you. So let's say you bought a property and it didn't go up in value a single dollar for 30 years. It's never happened in the history of real estate, but let's say it happens to you. Guess what?
No, it has. It has definitely happened in history. If you bought it exactly the wrong time in 2008, 2009, you've definitely experienced this.
No, I'm saying over a 30-year period.
Oh, right. I'm sorry.
Yeah, over a 30-year period. I'm saying if your property is no higher 30 years from now than it is now. I'm saying that has never happened. But let's just say, for the sake of this example, that happened. You bought a real estate today. It didn't go up a single dollar. It was worth exactly the same 30 years as it was worth now. Guess what? Your tenant still would have paid off your entire mortgage. You would have built all of that equity without any market appreciation at all. And you would own the house free and clear. So you're still building equity, even if the market doesn't do anything, right? So that's a separate third profit center. Number 4, real estate. And again, we're talking about residential investment property. We are not talking about a primary residence that you live in. We are talking about residential rental property. That is the most tax advantaged asset class in the United States. Okay. The government wants to incentivize you to buy rental property and provide housing for the population so they don't have to do it. And they will heavily incentivize you to do that. So the IRS allows you to depreciate the value of your property even if it's going up in value, right? Now you have to break out the value of the land. They don't let you depreciate land, but the structure of your property can be depreciated over 27 and a half years. So let's say you bought a $350,000 property. You said the land is worth about 75 grand. So the structure of this property is worth $275,000. The IRS says you can take a $10,000 paper loss per year for 27 and a half years in a row on that and take that $10,000 loss. We call it a phantom loss because you didn't actually lose anything, right? The phantom loss against real estate income that would otherwise be taxable, okay? And when you are ready to sell the property, if you do what's called a 1031 exchange, that's the number in the tax code, right, that allows you to do this, and you sell the property and you reinvest all of your proceeds into other like-kind properties, like you buy more rental properties, they allow you to indefinitely defer all of your capital gains and all of your depreciation recapture. And you can continue to do this all the way until death, at which point your heirs inherit the property, the basis resets, and nobody ever pays the capital gains or the depreciation recapture on those properties. Okay, so you have these tax benefits which are working for you and keeping a lot of money in your pocket as well. That's number 4. And the 5th one is the amazing built-in, not just hedge against inflation, but the ability for you to actually profit from inflation, which now is unbelievably relevant, right? I mean, I know you talk about inflation on this show, and so your listeners probably know that in the decade leading up to 2020, the official rate, we're going to use the official rate. A lot of people think the real rate of inflation is a lot higher than the official rate, but let's just be conservative and talk about what they tell us the official rate is. Leading up to 2020, the decade prior to that, the official rate of inflation was less than 2% a year on average, okay? Right now, the official rate of inflation is about 8%, right? 7.9%, I think, was the latest that they told us it is. So you're talking about a 4x increase in inflation. Now, for most people, that's really, 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 really bad, because if you have your wealth and you have your money and you put it in a bank account or something, all of a sudden inflation just eats away at it, right? And $100,000 today is only worth $92,000 at the end of the year in buying power. Well, if you own rental property, what you're doing is you're actually getting on the other side of this equation and you're positioning yourself to benefit and profit from inflation. How does that work? Number 1, home prices rise with inflation. Number 2, rents rise with inflation, okay? And number 3, if you take out a 30-year principal and interest fixed rate mortgage, you are borrowing that money from the bank in today's real dollars. The bank does not ask to be paid back in inflation adjusted dollars. So you are paying the bank back in future diminished nominal dollars that are worth less than the dollars that you borrowed. So you are actually profiting as inflation increases. So that is your 5th profit center. So all of these are working for you at the same time, which is also a really good downside risk hedge, because if one or two of them doesn't materialize in a particular year, the market didn't go up, or I had some vacancy and my cash flow got disrupted, or something else happened, well, guess what? All of these other profit centers are still kicking for you and can still make it a profitable investment.
Okay, so that was a lot, Matt. Let's actually hit a pause button on some of that. I want to actually go through some of the reasons why I have you on this show. And so we've got folks here that are still kind of having difficulty with the base amount of capital. They'd like to own real estate. So I'm just going to say a few things to our folks. The 5 things that Matt is talking about are real things. And I know for a lot of you, you're like, May, I have to actually get that base capital, period. But what I wanted to mention was that for most folks, as they do their financial journey, it's very common for folks to do the savings first and then to try maybe some stuff in the stock market because they might want to save something in an IRA account or something like that. And then once they get a certain amount of base capital, to consider real estate as investment, either through their own personal home. And then a lot of folks, if they're starting out and they're self-made versus, getting a windfall from a family member that has passed away, then real estate becomes one of many ways that they diversify. So one of the things I just want to point out to our viewers is that it is very rare that people, as they go through their financial maturity, only have one type of investment in their overall way that they think about their net worth. So that's part of the reason why Matt is on this show. Now some people want to buy their own home first. And then some people are like, no, you know what? This is a legitimate dividend yielding thing. So I want to kind of go on the first one. The first thing that you talked about, which is one of the 5 points, you talked about just dividend yielding, cash flow and stuff. So we want to talk about the fact that this asset is not liquid. So for someone who is really into liquidity, you want to just talk about that really quick, Matt?
Yeah, absolutely. I guess
that people have in their mind when they're coming to you, and this is a choice that they're like, I'd like to have this conversation with Matt.
That's right. So it is an illiquid asset, right? It's a hard asset. It's a physical asset, right? Which has pros and cons to it, right? The con is that you can't sell it and get all the money out in 24 hours, right?
No, that would be right. That's what you're looking for. This is not the thing that you should. Yeah.
Right. You can't sell it and get all your money out in 24 hours. You would need to, put it on the market and list it for sale and all that kind of stuff. And so the liquidation period is longer, right? Now, that also, though, ties into a lot of the benefits of why people like to own hard assets, right? Your asset is not going to disappear it also, for the same reason, cannot disappear overnight in a stock market scandal. A thief cannot run away with your house, right? Et cetera, et cetera. And so a lot of people like the ability to own a hard physical asset, right? You actually own the bricks and the lumber and the granite and the glass and the cement and all of those things, right? And so it provides both of those things. But absolutely, that is right. It is not a liquid asset, which has both benefits and cons, depending on how you're looking at that. Yeah.
And now tell us the tip.
Bernie Madoff's house.
You know what? Let's get together and buy Bernie's house. I bet it's a beautiful property, David. Go ahead.
I have a quick question. Okay, the higher the cap rate, the lower the price, correct?
Not necessarily. There's not a necessary correlation there. Oftentimes that is true. Oftentimes when you buy lower priced properties, the price to rent ratio becomes more advantageous and the cap rate becomes more advantageous, but it's not necessarily the case. You can buy plenty of inexpensive properties that don't have great cap rates, and sometimes slightly more expensive properties do have decent cap rates. But yeah, what we like to talk about is this concept of, in any market, by the way, right? Like when I tell you, St. Louis has been a very popular market for us this year, that does not mean that any property in St. Louis is a good investment. And in fact, most properties in St. Louis, and this is true for any market in the United States, most real estate is not going to be good as an investment. And the reason is for one of two reasons. Either A, it's too expensive, it's too high end, and you're not going to be able to generate enough rent to make it a really good cash flowing investment for you. Or the other reason is it's going to be too low end, is not going to be in a desirable area, and you're not going to be able to attract quality tenants that are going to treat the property well, pay the rent on time every month, and you're going to have a high turnover rate, high maintenance, high vacancy. It's going to disrupt your cash flow, and it's also not going to be a profitable investment. And so one of the things that our company does is we work with local market professionals on the ground in each of these companies that does this professionally every single day and buys and renovates and leases out and then offers through my company, Maverick Investor Group, to my clients as an off-market buying opportunity, turnkey rental properties that are in those real estate investors' sweet spots in these markets that make the most sense for attracting quality tenants, but also giving you that cash flow.
Yeah, thank you. I just sold some properties in Texas, and I noticed that the buyers were paying cash, so that takes out the leverage advantage of it, right?
Yes, if you're paying cash, it does take out the leverage advantage, and it takes out the exactly. But you still get, the appreciation. You're going to get more cash flow if you don't have a mortgage expense, right? So your actual cash flow that you're getting is going to be higher, although your cash on cash return will likely be lower. So maybe we should talk about that. If you buy the property for cash and you have no mortgage expense, then obviously the amount of cash that's coming into your pocket is going to be a greater amount each month because you don't have to pay a mortgage expense, right? But the cash on cash return is oftentimes going to be lower because if you only put 20% out of pocket, right, your net cash flow after your mortgage expense will be less, obviously, because you have the mortgage expense. But then when you divide whatever's left over by the money you invested to see what's your cash on cash return, meaning how much return are you getting by the total money that you put out of pocket if it was just the down payment and closing costs, usually the cash on cash return will be higher if you use leverage. So that's exactly right.
Plus you don't get the mortgage deduction.
You get a mortgage deduction. Yeah, it's everybody's personal decision, in fairness. And I feel like you guys do a good job about talking through that with people because, one thing, in case we forget to mention it, your organization does provide kind of consulting services as people are just trying to learn this.
Yeah. And the beautiful thing is that it's all free. I mean, that's what I was mentioning at the beginning. You never, ever have to pay any money at all to work with Maverick Investor Group. Everything we do is free, whether that's providing free educational materials like articles where you can read about this stuff, free webinars where we interview experts in all these different areas, all free for you to watch. You can attend our private buying opportunity events and actually get access to these properties, no charge for that. And you can do direct video consult with us where we will take the time. We want to get to know you. We want to get to understand where you are in your investing journey. We want to answer your questions. We want to understand your buying criteria, your investment goals, and we want to help you to develop a plan to get there through rental properties. And all of that is free. We just do it at no charge. The only point in this entire process where a Maverick Investor Group makes money, and we set it up this way to financially incentivize ourselves to deliver value to our clients, right? The only point in which we make any money at all in this process is if we can help you to identify a rental property that meets all of your needs, and you do your due diligence on that property. You do your home inspection, you do your appraisal, you do all of your due diligence, and it passes all your due diligence such that you're totally satisfied you decide to close on that property. Only then do we make any money at all. And even then, it's not from you. It's not from the buyer. We get paid 100% by the seller.
Now, what's the time horizon that people are going to, like your typical, the typical person that decides to embark in this portion of the financial journey, how long are they mentally thinking they're going to hold these properties? And then what have you seen is the reality of how long folks are holding the properties? I do think
a long time.
Yeah.
This is not a flipping play. I mean, that's actually really important because a lot of the, narratives in some of these investment spaces is about flipping properties, right? And if you flip a property, you are getting rid of most of these profit centers that we just talked about, right? So these profit centers that we just talked about are for long-term buy and holds, right? Depreciate that property over years, right? Have your tenant pay down your mortgage over years, right? Allow the market appreciation to accumulate and accrue over years, right? Collect that. And our clients want to collect that cash flow every month. Right. And so they want to buy a very
stable form of return. I think that some people just discredit a lot, but this used to be the way that a lot of folks made their retirement.
Absolutely. Yeah, absolutely. And then as you buy more properties, then all of a sudden you have more streams of income, right? And your passive cash flow just continues to increase.
Cool. The last thing I want to ask you, because we are getting close to our time, is that some people, do you know much about, and if it's not your area where you like to talk about, some people do purchase these properties in an IRA, or no, you cannot do it that way?
100%. Yes, absolutely. You can, although there's a big asterisk there. Okay. So here it comes. All right. The government, the IRS, okay, says absolutely 100% a retirement account like a 401k or an IRA or a Roth IRA or any of these vehicles, the government says absolutely 100% you can buy rental properties in them. You can own real estate 100%, no problem. The problem is that a number of custodians, right, companies that administer these IRAs and 401ks, for example, if you have a W-2 job and you work for a corporation and they allow you to contribute to a 401k plan, I can almost guarantee you that that particular 401k plan will not allow you to invest in real estate. Now, one of the reasons, of course, is because there's money to be made by these companies when they're investing you in mutual funds and they get money off of it. Whereas if they allow you to just go off and buy a rental property, they don't make any profit from that, right? So there's a lot of reasons, different reasons why they may restrict your what you can buy, but that's only the specific plan that's restricting it. It's not the government. And so if you start what is called a self-directed retirement plan, although even that term is getting co-opted into marketing jargon that means very different things. But if you start a truly self-directed retirement plan, which I can absolutely direct you to companies that do that. My plans are self-directed. So Roth IRA, I have a solo 401k. It's all 100% self-directed, which means I can do all kinds of stuff with it. I mean, I can go into cryptocurrency and do decentralized finance stuff. I mean, I can do any of that stuff, right? I can buy cash flowing rental properties. I can do all of those things. Really, the two main categories that are actually prohibited by the government are you can't buy collectibles, so you can't go buy a bunch of baseball cards, and you can't buy life insurance, right? I don't want to be giving legal advice in case there's a couple more nuances beyond that or anything. So not financial advice, but I can absolutely connect folks with companies that do self-directed retirement plans. So if you have one that you want to roll over into a self-directed plan, or you want to start a self-directed plan or something like that, absolutely. And our clients buy rental properties in those all the time.
Interesting. Okay. David, do you have any more questions? Because we are coming close to time. Should I shut it out, or did you want to?
No, I do not. Thank you, Matthew, very much. Thank you.
This has been so amazing. And I probably could go on all day with Matt, quite frankly, on this, because it's such an interesting topic. If you guys want to learn more, please look down below. If you are a member of the subscription for Markets with May, we will put it in the Discord. But at a minimum, even if it's not something that right now is the timing that you want to do it, I think it's really smart for all folks to just get educated on different types of investment possibilities. So with that.
Yeah. And if anybody wants to connect with us directly, like I said, we're happy to offer a completely free video consultation, answer all your questions, talk to you about that stuff. And you can just go to themaverickshow.com/consult and just sign up for a totally free consult there. And we would love to meet you and get to know you and answer all your questions.
Awesome. All right, guys, have an amazing weekend. Good luck in this marketplace. Bye.